Now, how we get to this conclusion has been done with a lot of math, and I'm going to do it a little bit with the graph. But before I get to that, I want you to see how I see investments. And I see investments, believe it or not, an awful lot like roulette wheel gambling. Now, a roulette wheel, an American roulette wheel, just a quick background on that, an American roulette wheel has numbers 1 through 36, and it also has a 0 and a double zero. The 0 and the double zero are green, and the numbers 1 through 36 are, some of them are red and some of them are black. The odds that the casino pays out are based on 36 numbers, but there's not 36 numbers, there's 38 numbers. So the casino's edge is by paying out 36 to 1, when there's 38 numbers, they have a 2 and 38 edge. And a 2 and 38 edge is a 5.26% profit to the casino. So whether you speculate in red or black or high or low or odd or even or even a single number, on average you're going to lose 5.26%. When I go to casinos occasionally, and when I watch casinos, that's how I think of the roulette wheel. Everybody there, no matter how they're betting, every time you place down a bet, is losing 5.26%. Now, if you were to watch the table, you'd see a tremendous amount of excitement, and you could get caught up in the excitement. And you could get caught up with the idea that, oh, there were just 2 5s in a row. Surely, if 2 5s have occurred, the next one's likely to be another 5. Or, gee, the first one was my son's birthday, the next one's got to be my daughter's birthday. And people get very wound up in this idea of trying to predict where the next spin of the roulette wheel is going to go. But if we assume that this wheel is perfectly random, that it's perfectly weighted, and that the people are honest and the ball is being spun in a perfectly random way, if everything in that wheel were perfect, then we'd know that this theoretical model we came up with, that no matter how you bet, you're going to on average lose 5.26% of your money, we know that that would be an appropriate model. But of course, there is no roulette wheel that's perfectly weighted. Every roulette wheel has some sort of imperfection. But I would still hold that even though the theory's assumptions are violated, wheels aren't perfect. This is a good theory as to how to conduct your life. Stay away from roulette wheels. You're losing. Some numbers you might lose only 4%, and some numbers you might lose 7%, but it's a real good theory and it works. And similarly, this capital asset pricing model, which was based on these very idealized assumptions, and a lot of people will attack them for those idealized assumptions, and it doesn't describe everything perfectly, but as far as I'm concerned, it's the best starting point for you to make your investment decisions. So that's what I'm going to be talking about today, is the starting point for making your investment decision. We're going to switch over. Let me go through a little bit of the explanation here as to why the capital asset pricing model says this, and then maybe we can start to get a little bit more interactive when I get into how you would implement this sort of idea. So this is how Markowitz did it. He did it with math, but we're looking at it graphically. On the horizontal axis here, this says standard deviation. We just want to think in terms of risk. And on the vertical axis here is expected return. Every investor wants more money. If you don't want more money, come see me. More money is nice, and of course we talked about less risk being nice. And we imagine there's millions of dots out here. We've just graphed a few of them in yellow here, but millions of dots, all of which reflect individual assets. This one down here might be IBM. This one up here might be Apple Computer. This might be even a little bit of a mutual fund or something. And what Markowitz showed, and which is absolutely true, is probably one of the most important things that I'm going to say here, and that is that diversification, putting together assets that don't always move together, putting together these diverse assets creates diversification, and here's the important point. Diversification reduces risk without reducing expected return. That's the principal message to come out today. It's the one free lunch. They say economists don't believe in free lunches. I'm a financial economist. I'm telling you diversification is a free lunch. It's your ability to reduce risk without reducing expected return. It makes common sense. If you put together a whole bunch of assets here that have an average return of maybe 10%, the portfolio of them will still have an average return of 10%, but it'll have a lot less risk. Now I talked about this, if we take the high point of the stock market, the Dow Jones being 14,000, and the low point a couple years ago, I think it was down around 7,000, that's roughly a drop of 50%. That's pretty dramatic. But if you look at most stocks in the U.S., just in their last 52 weeks, if you go into Yahoo and put in some symbols, and start putting in ticker symbols, and you look at the 52-week high and the 52-week low, generally speaking, you're going to see that the high is twice the low. There is tremendous variation in the returns and prices of individual securities. Putting your money in one stock is tremendously risky. In fact, this graph really doesn't even express it correctly. If this is the market portfolio here, the fully diversified portfolio, the risk of individual stocks are way out over here. Individual stocks are enormously risky. As you start to put a few together, the risk goes down. More and more together, now we might even be to the sector level. But how can we get as far over here as possible? Well, some people were thinking that the best thing you can do is to invest in a portfolio that is diversified to form the lowest possible risk. Makes a lot of sense, but it's not exactly right. We actually don't want the lowest risk portfolio. We want the portfolio that gives you the greatest return per unit of risk. And that portfolio is the one that's shown in red here. It's the tangency portfolio. So that if we take a line that goes from our risk-free rate, this is as technical as it's going to get. And there's no quiz afterwards. If we take a line that starts at 1%, which is about what you get now in a money market, a mutual fund maybe, and we look at which asset we want to combine that with, the one that makes the most sense is the point of tangency, because our objective is to go north and west, and this gives us the most northwest location we can find. So we should put our money here, and we should put our money there, and what the modern portfolio theorists taught in the 1960s is that that portfolio has a very specific identity. It's the market portfolio. And what do I mean by the market portfolio? It's the portfolio with everything in it. And I'm going to flesh out in detail exactly what I mean by that and how those assets are weighted. I really don't mean just the U.S. stock market, by the way. I include international stock markets, and it's not just stocks, it's other things. I'm going to get into that later. But right now, I just want to talk about, so this is kind of a pictorial representation of why they say you only need two assets. And you say, well, wait a second, shouldn't I put some of my money in the tech fund, and some of my money I should put into a utility fund, and some of it I should put into a value fund, and some of it I should put into a growth fund? And the answer is no. This is the only asset you need. This asset gives you a better set of combinations. If you want to be safe, you put most of your money in treasury bills and you end up down here. If you're willing to take more risk, you come up over here. You can even leverage and borrow and go out here. I wouldn't recommend that. But this combination is better than any other combination you can find. That's the logic. And it's a persuasive logic if you ask me. There's theory as to why we believe that this is the very best portfolio to invest in. And I'm going to talk more about what that very best portfolio is.